Soybean futures are the highest since May 2018. Corn and wheat futures are testing 2020 highs. Why?
Soybean futures are the highest since May 2018, and corn and wheat are testing the 2020 highs because of a dry August, reducing the U.S. crop numbers, and China continues to buy U.S. corn and soybeans.
What did the USDA say in their September report?
Last Friday, the USDA came out and pretty much said what the trade was looking for. They lowered U.S. corn acres slightly. They lowered U.S. corn and soybean yields. This lowered U.S. and world corn and soybean carryouts. And they also raised world wheat carryout and production. The response by the managed funds was they came in and bought this neutral report, which was kind of a surprise. Farmers, especially in soybeans, sold this rally also.
What is the latest managed fund net grain position?
Managed funds right now are long 195 beans, 42,000 contracts of meal, 88,000 contracts of oil, 57,000 contracts of corn, and 22,000 contracts of Chicago wheat. They have bought almost 100,000 corn in the last few days, and are now long close to a record soybean position. Market's overbought, and I think some people think that we need to pull back a little bit as the harvest nears to kind of reflect value of the global supply and demand, which right now is still adequate versus demand.
Should U.S. farmers sell into this rally?
I really think U.S. farmers should increase cash sales. Now that we're close to $10 November beans, a little bit of an inverse into 2021. They should probably increase cash sales by 10% for anything that's in inventory, anything they're going to harvest this fall, and next year's 2021 crops. As far as the corn and wheat, I also think that they should be selling corn at these price levels. I know farmers are reluctant to do that because if there's another COVID payment, they only get paid for what's in inventory. And a lot of farmers are opting to sell beans and store corn just for that matter. But at least they could go ahead and sell the 21 crop at these price levels. And as far as wheat is concerned, a lot of people feel that the wheat market is overvalued. And selling $5.50 nearby Chicago wheat and $5 nearby Kansas City wheat might be a prudent thing to do.
What will the Federal Open Market Committee likely say in its statement following the conclusion of its two-day policy meeting on Wednesday?
Following news that recently the Federal Reserve has adopted a plan of average inflation targeting. Actually, this plan may have been in place for a while, but it has been formalized now. So basically, this suggests that interest rates will stay low for a very long period of time. The Fed may not be in a position to hike rates anytime soon, maybe not for 3 years or more. Some analysts are thinking that it could be quite a few years before the Fed is able to raise rates. Some traders may be anticipating this potentially dovish statement from the Fed at the conclusion of their meeting on Wednesday. And that may be the main reason today why we're seeing such strong gains in stock index futures.
What is the long-term outlook for the U.S. dollar?
Well, we are seeing some pressure coming into the dollar index today, and it does look like if the Fed remains on hold for quite some time, that is a fundamental that will undermine the U.S. dollar for a rather long period of time. So I would expect the dollar index to drift lower as interest rate differential expectations continue to undermine the greenback.
What are the technical aspects of the U.S. stock index futures?
Well, in the last few days, the S&P and the Dow futures have broken out to the upside above a downtrend line. Could be that traders are anticipating some bullish news coming down the road. I think that bullish news may possibly be in the form of easier credit from the Fed in one degree or another, or at least an extension of the ongoing easier credit policies. So something is bullish, I think, on the horizon, and these breakouts to the upside suggest that there will be better news supporting both the S&P and the other indices.